Very important topic from module B. Types of risk means we'll be covering major risks over here. See, there are many risks, almost 15 risks in banking. Okay, but we'll be covering the important ones which are there for CAIIB. So follow this video completely, and also firstly download Adda 24/7 app on your mobile. In this app you'll be getting all the premium study material, current affairs, job alerts, daily quizzes, live classes, plus notes, question banks, tests, what all you need for JAIIB and CAIIB and other banking exams. You'll be getting it over here. Okay, also subscribe to Officers Adda 24/7 YouTube channel. In this channel you'll be getting the updates for JAIIB, CAIIB and various banking exams, and also free YouTube series. Now free YouTube series, I would always suggest grab whatever is available free on internet. We'll be covering the YouTube series on various topics right now which we are covering, like BFM. There are many other YouTube series also going on. So click on the bell icon so that you can get the updates on the regular basis. These are the 2 new batches for CAIIB starting from January 20th, English and bilingual. You can join as per your preference. And also remember, there are huge discounts going on. Everyone put the code Y432. Never forget this code Y432. I'll write it over here. See this. Draw it over here. Okay. The code Y432 is very important for discounts. I'll show you at the end. Yesterday I had given you an homework. It was, you had negotiated an export bill for your customer in May 2009. The bill has been returned by the overseas buyer for some reasons, and the AD has to debit a customer's account with Indian rupees. The rate at which it will be applied is, so it's very simple. See this. You had sent the export bill. So while sending the export bills, what rate did you take? You had taken the bills buying rate at that time. Okay. So whenever you do any export, we apply the bills buying rate, and forward transaction we had done. So now the bill has been returned. Okay. See here, this I am X over here, and I had sent the documents to USA over here. Now this USA bank, some bank XYZ over here. Okay. USA bank. Now this bank had to pay me because I am the exporter over here. Exporter, and this guy, this customer is the importer over here. Importer. Right? But what has happened is, importer's bank has returned the documents saying that we are not accepting the documents. When such documents are returned, I'll have to do a reverse transaction. So in the initial stage, what did I do? I applied the bill buying rate. Bill buying. Okay. So now I'll have to apply the selling rate, reverse one. So firstly I'll apply selling. Okay. Then done with it, selling. But now which selling? TT selling or bill selling? This or this. Okay. So you'll say bill buying, then I'll take bill selling only now. No, don't take bill selling now. Why? Because when you did the export transaction, you had a forward transaction, means the payment was to be made on some future date. So that's why there was a risk involved in it. But today it has been returned, and there is now that there won't be any money coming. So there is no risk involved in it. You will directly apply the TT selling rate. So the answer to this is TT selling rate. You will close that bill using TT selling rate. Okay. Debit that customer and credit that those dollars whichever are required. Right. Okay. So what are the types of risks in banking? Okay. Firstly, liquidity risk. It is the inability to obtain the funds at a reasonable rate for meeting the cash flow obligations. Remember, liquidity risk means what? Suppose if I have to give some EMI of your bank, let's say I am the customer of your bank and I have to give the EMI. So if I don't have the EMI, that's my liquidity risk, isn't it? So obtain funds at a reasonable rates for meeting the cash flow obligations. So if I have to obtain funds, means I don't have funds for meeting the cash flow obligations, means my EMIs. So that is basically the risk which I am facing. Liquidity risk will be of 2 types. Always remember, principal. Okay. Principal means I don't have money to pay the principal, and second is interest. Interest. I don't have money to pay the interest, right? So it can be of 2 ways. Firstly, liquidity will be the problem maybe of principal, and second is of the interest. Okay. So move on. This liquidity risk is of the following types. Number 1, funding risk. Funding means what? It is unanticipated withdrawals and non-renewal of FDs, which are raw material for the fund-based facilities, right? Means if my bank is having FDs and nobody is ready to renew that FD with my bank, then what happens? Savings account. People are withdrawing from my savings and current accounts. Then what happens? I won't have money to fund the loans, isn't it? So that is the problem. That is known as the funding risk. Bank, how does the bank run? Bank always runs on almost free capital. Current account, no interest, right? The saving account, almost 3 to 4% interest. And this FD, they are having a slight bit of higher rate of interest, but mainly CASA. So if I don't have CASA accounts and low rate FD accounts, then I'll be in a problem over there. So that's known as the funding risk, isn't it? So unanticipated withdrawals and non-renewal of FDs, which are raw material for the fund-based facilities. Second is time risk. It is a risk of non-receipt of expected inflows from loans in time due to higher rate of NPS, which will create the liquidity crisis, isn't it? Means what? Non-receipt of expected inflows means the EMI which was to be received by my bank from the customer, right? That EMI will always have a higher rate of returns here. Logic is very simple. I am a bank. Okay, what do? What is my basic role? I'll give the loan, and this loan person will give me EMI. The rate of interest is, let's say, 8%. Okay, so what will I do with this EMI? I am having depositors over here, right? Depositors. So these depositors, I'll have to give the interest to them, right? So that should be lesser than this 8%. So that should be around 6%. So this 2% gap, I'll carry out all my salaries and running expenses, right? But if this 8% stops over here, then what happens? Then I won't have money for this 2%, I won't have money for the 6%. So that is known as a time risk. Third is the call risk. It is a risk of crystallization of contingent liabilities. Means if I am the bank, I have given a, let's say, guarantee on basis of somebody. What is crystallization basically? Say this, I am a bank, I have given a guarantee, issued a guarantee, okay? Guarantee. So guarantee means what? I don't give the immediate payment. It's called as contingent liability. But if the person to whom I have given the guarantee comes to me for money, that you had given the guarantee, now pay me. So that is known as crystallization. Okay? Crystallization is actual payment of money for that guarantee. That's the basic meaning of crystallization. Next is interest rate risk. Risk of loss due to adverse movement in the interest rates. This is basically interest rate. Adverse movement means what? What do you mean by adverse movements here? It's very simple. For deposits, okay? If my rate of interest is presently 6%, let's say, and it moves to 8% for deposits, it will be called as adverse movement. Adverse, okay? But if my deposit rate is 6% and it moves to 4%, then it won't be called as adverse movement because I have to give lesser amount. It is called as favorable movement, right? So understand the difference between adverse and favorable movement. Similarly, vice versa, reverse is the case for loans. If the loan rate is 6% and it goes to 8%, then it is favorable for me because I will be getting higher rate of interest, and vice versa over here, right? So risk of loss due to adverse movement of the interest rates is known as the interest rate risk. This interest rate risk is of the following types. Which one? Gap or mismatch risk. The risk of gap between the maturities of assets and liabilities. This is basically gap or mismatch. Means what? I'll give you a simple example. Suppose if I am having an FD, let me keep it over here, FD, okay, and this is a loan. I take a FD of 1 lakh for, let's say, 1 year. What will I do with this 1 lakh FD for 1 year? I am a bank. I have kept it over here. I'll give it as a loan. Right? This 1 lakh I'll be giving it as a loan. But this 1 lakh when I give it as a loan, okay, let's imagine I give this loan of 1 lakh for 3 years. 3 years. Now what will happen? After 1 year, this FD person will come to me for withdrawal. But I don't have money because this money of 1 lakh I'll be receiving it in 3 years. So I'll be in a gap risk or mismatch risk. The risk of gap between the maturities, remember maturities, okay, of assets and liabilities. Sometimes long-term loans are funded by the short-term deposit. Same example, short-term deposit 1 year, long-term loan 3 years. So that is wrong. Okay, that's called as a bucket system. RBI has introduced the bucket system. Kindly study that. That's a very good topic actually, but it will take a huge time. Okay, bucket system, very good topic from RBI. Next is the basis risk. Basis risk means what? Change of interest rate on assets and liabilities may change in different magnitudes. Means what? Let's take one example over here again. Okay, means let's say the loan. Okay, let me go it this way. Let me write it over here. Okay, let's say this is a FD and this is a loan. Okay, now what happens? The FD rate is, let's say, 6% and the loan rate is, let's say, 8%. Okay, now what happens? This FD rate grows from 6% to, it rises. Okay, it rises to 8%. So earlier gap of mine was what? 2% over here. 2% I had a gap, right? I was earning 2%. 8% I was getting it from the loans and giving 6%. 2% was my income. Now this FD raises from 6 to 8, but the loan raises from 8 to 9 only. So now what am I earning? Only 1%. So this is known as my basis risk. When the rate of interest on deposits and loans change in different magnitudes, see, this has increased by 1% and this has increased by 2%. When they change by different magnitudes, it is known as a basis risk. Okay. Next is the embedded option risk. Means what? Adverse movement of interest rate may result in prepayment of CC or term loan. Means what? Let me give you an example over here. Suppose if I am having a loan, okay, I am the bank. Let's say I am the bank and I have given a loan of, let's say, what, 8%. Okay, 8% I have given a loan to my customer, standard customers, good customers. Now what happens? Your bank decides to increase the rate of interest of that loan from 8 to 11 directly. We will increase the rate of interest from 8 to 11 because the loans are unaffordable at 8%. You will tell that customer, see, we have increased the rate of interest at 11%. So he'll say, okay, I can't afford 11%. What I'll do is I'll repay your loan. So he'll prepay your CC and term loan. DL means demand loan. He'll prepay your CC, demand loan and term loans. He'll repay it to you. So then this is known as the embedded option risk. Okay. So these were the major risks which are to be covered for for this BFM. Okay. We'll be covering some other risks in the future lectures also. Okay. Now let me get back to this before going on to the questions part. This is the new batch which I have spoken about, English and bilingual. Remember, we'll be covering all the subjects ABM, BFM, ABFM and BRBL. And also remember, we'll be covering the numericals, case studies, objective questions, theories, everything we'll be covering for this. Okay. Now important part, how to get the discounts. I'll come to the discounts part later. Let's cover the questions first. Okay. Now answer this. Uncertainty with regards to interest rate at which the future cash flows could be reinvested. Uncertainty with regards to the interest means if I am having some FD right now, next time when I try to rebook that FD, will I get the same rate of interest? No. So that is what, which type of risk is this? Reinvestment, interest rate, gap, or none of the above? Which is this type of risk? So that if I am having that FD at 8% now, and after the maturity of this FD, will I get 8% again or will I get 6%? So this is known as reinvestment, correct? It's known as reinvestment risk. Whether I'll be able to get the same rate on my FD, that is known as reinvestment risk. Second one, when the bank borrower or the counterparty fails to meet its obligations regarding the returns, regarding the terms agreed with the bank, it is called as, means if I am the bank over here, okay, and this bank gives a loan to the customer, okay, loan. Now if the customer is not able to repay, so this is known as which risk? Market, operational, liquidity or credit risk. Everyone be fast. So customer is always known as a counterparty, okay, or borrower. So which is this risk? This risk is known as, correct, credit risk. Very good. Good guys, good going. When the bank chooses the wrong strategy or follows a long-term business strategy, which might lead to its failure. It is called as means. For example, I'll give you Nokia. Nokia was one of the biggest mobile companies in 2004-5, but where is Nokia now? Why? Where is it gone? Kodak Films. Remember anyone? Kodak Films, biggest company on the films, in that camera film segment. Where is it now? Gone. Okay. So what is happening here? A bank chooses a wrong strategy or follows long-term business strategy, which might lead to the failure. It's called as credit risk, operational risk, market risk, and strategic risk. This is also known as business risk. Okay, there is also one word for this, business risk. Okay, so what is the answer for this? A, B, C, or D? Credit, operational, market, or strategic? Yes, fast. It is simple, correct. Strategic risk or business risk. If you don't see what is going on in future, you'll go to in thin air. Okay, that's the same simple logic of any business. Uncertainty with regards to interest rate at which the future cash flows could be reinvested. Means the future cash flows, whatever I am getting in the future, it will be reinvested at with the I think so. It's a repeat question. One second. Yeah, it's a repeat question. So it is basically reinvestment risk only. Okay. Now one for your homework. The yield to maturity of the bond is same as, means what do you mean by this YTM? The present value of the bond, future value of the bond's internal rate of return, and none of these. I'll answer this tomorrow because you need to think on this. Very simple. Okay, very simple. Okay, so definitely go for it. Okay, now I'll tell you about these batches here, how to get the discounts. Use the code Y432 I told you. Let's go live to Adda 24/7. There you will see the how to get the discounts. Okay, I'll show you live over there only. Let me come to Adda 24/7. If you are having the app, I would always suggest go through the app. Okay, in app you will be getting 1% extra due to the coins system available over there. Okay, so now go to this, go to the site. On the side you click on this JAIIB and CAIIB. Once you click on this JAIIB and CAIIB, see the JAIIB, CAIIB, Mahapack, CAIIB 23. Click on CAIIB 23. You'll see the batches over here. Click on this English batch. Go through the details of the batch. Okay. Then 20th January, timings are given, days are given, study plan is given. You can go through it. Main I'll cover. We have a recorded 24/7 videos available, so that if you miss out any class, you can definitely go for the recorded videos. Also interactive live classes, so you can definitely ask the questions and clear your doubts there and then itself. Fees is 23,999. I'll show you how to get the discounts. Click on apply. Okay, get discounts. Put the code Y432. Once you click on offers, you'll see this. Click on apply. Now look at this. 23,999 reduces to 5519. Okay, it's a huge discount which you are getting. Okay, also I would suggest, instead of going for a single batch, I would suggest go for the Mahapack. In Mahapack, what do you get? You get multiple batches. See this JAIIB, CAIIB, Mahapack. You get multiple batches. Now click on this CAIIB ka Mahapack. I'll show you that also. Very simple thing, isn't it? Click on CAIIB ka Mahapack. Once you click on this Mahapack, you'll see the details. Again, the same details you'll see. Okay, 15 plus batches for ABM, BFM, ABFM, and all the 4 subjects. 15 plus batches. Then recorded videos are available. Then mock tests are available. Topic wise question books are available. Everything is available over there. Okay, click on this. Now look at the fees part. 35,996. Click on view offers. Put the code Y432. Y432. Click on apply. Now see, 35,996 reduces to 8279. Such a huge discount you are getting. Go for it. Okay. Click on continue and you can definitely get it over here. Okay. Why am I stressing? Because see, the batches, the portion of CAIIB has changed now. What is the new portion? See this. Go to the new portion. See this. 4 papers: ABM, BFM, ABFM, and BRBL. Also, there is an electives are rural HR, IT, and central banking and risk. No retail. Negative marking is gone. That's something good for you. Also, subjective questions are available. You have to answer subjective questions in the paper this time. That's why I would suggest go for the classes. You will be needing a mentor.